The United States is facing one of the most serious financial challenges in its modern history. It's a crisis that has been building for decades, quietly growing in the background of American life. Today, it's impossible to ignore. I'm talking about the national debt, a figure that has reached historic, almost unimaginable levels. For generations, America has run on borrowed money. But the scale of that borrowing today is raising urgent questions about the country's long-term economic stability, its power on the world stage, and the future of the American dream itself. This is the story of how the national debt got so big, why it matters now more than ever, and whether the United States can steer away from a fiscal cliff. So, what exactly is the national debt? Simply put, it's the total amount of money the US federal government owes to its lenders. This isn't just one big loan from a single bank. It includes money borrowed from foreign governments like China and Japan, from private investors, massive pension funds, and even from everyday American citizens who buy treasury bonds. Think of it like a household budget. When the government spends more money than it collects in taxes, it runs a deficit for that year. To cover that shortfall, it has to borrow. Over time, all those annual deficits pile up, accumulating into the national debt. For a long time, this borrowing was seen as manageable, even normal. Interest rates were low, which made the debt cheap to carry. And the US dollar's status as the world's primary reserve currency meant that investors all over the globe had immense confidence in America's ability to pay its bills. But today, the numbers are no longer small, and the old assumptions are being put to the test. The explosion of America's national debt didn't happen overnight. It's the result of decades of decisions, crises, and policy choices. It grew gradually through major events that each came with a hefty price tag. Think about the prolonged military conflicts in the Middle East, which required trillions in funding. Think about major tax cuts, which reduced government revenue without corresponding cuts in spending. And then there were the massive economic shocks. The 2008 financial crisis saw the government step in with huge bailouts to stabilize the banking system and prevent a complete economic collapse. Just over a decade later, the COVID-19 pandemic hit. In response, the government injected trillions of dollars into the economy through stimulus packages to support struggling businesses and families. These actions were arguably necessary to prevent even deeper disasters. They kept the economy from grinding to a halt. But the side effect was a dramatic and unprecedented expansion of federal debt, adding trillions in just a few short years. So, why is this a crisis now? After all, the US has had debt for its entire history. Well, debt itself isn't automatically a catastrophe. Many economists argue that the most important metric isn't the total number, but the debt relative to the country's economic output. It's GDP. As long as the economy is growing, a certain level of debt can be sustained. However, the alarm bells start ringing when a few things happen. First, interest payments on the debt start consuming a larger and larger slice of the federal budget. Second, investors both at home and abroad begin to question the long-term stability and whether the government can truly repay what it owes. And third, and this is the big one happening right now, rising interest rates make all of that borrowing much more expensive. As the Federal Reserve raises interest rates to fight inflation, the cost for the government to service its debt skyrockets. This creates a vicious cycle. More of your tax dollars have to go towards simply paying interest, which means less money is available for everything else. Things like infrastructure, healthcare, scientific research, or national defense. If the debt continues to grow faster than the economy, this burden just keeps compounding, year after year. A prolonged debt crisis could have very real consequences for everyone. It could lead to a future with higher taxes for all of us. It could mean painful reductions in government services that people rely on. It might force difficult conversations about cuts to popular programs like Social Security or Medicare. Ultimately, it could lead to slower economic growth, meaning fewer opportunities and a lower standard of living. In a more extreme, worst-case scenario, a loss of investor confidence could seriously weaken the US dollar's dominance on the world stage. The United States benefits immensely from the dollar being the global reserve currency. It makes our borrowing cheaper and gives us significant geopolitical influence. If global confidence were to falter, our borrowing costs could spike dramatically, triggering a severe financial crisis. Now, it's very important to keep this in perspective. The United States is not on the brink of imminent collapse. It still has the world's largest economy, the deepest and most liquid capital markets, and unmatched financial influence. But the current trajectory is unsustainable, and it raises serious long-term questions that we can't afford to ignore. One of the biggest hurdles to tackling the debt is political gridlock. The solutions are well known, but they are all politically difficult. Spending cuts are deeply unpopular with voters who depend on government programs. Tax increases are always controversial and face stiff opposition. And trying to reform major entitlement programs like Social Security and Medicare is often seen as a political third rail. The reality is that both major political parties have contributed to the rising debt over the years, through their own distinct priorities. Yet, finding a bipartisan solution remains incredibly difficult. The short-term focus on winning the next election often discourages leaders from making the tough, long-term choices needed for fiscal reform. Let's also talk about the connection to inflation. During the pandemic, the combination of massive government spending and disrupted supply chains was a key factor contributing to the surge in inflation. When there's too much money chasing too few goods, prices inevitably rise. That inflation eroded the purchasing power of American families, making everything from groceries to gas more expensive. While inflation has cooled from its peak, the experience left a strong public impression about the links between government spending and the cost of living. So, the big question is, can the United States recover from this? History shows us that America has a remarkable track record of overcoming major economic challenges. The key to stabilizing the national debt will likely require a balanced, multi-pronged strategy. This could involve a combination of controlled growth and government spending, targeted tax reforms that encourage growth, and most importantly, fostering strong economic expansion. Economic growth is the most powerful tool we have. If the economy, our GDP, grows faster than the debt, the burden becomes much more manageable over time. This is where American innovation comes in. Emerging industries like artificial intelligence, renewable energy, advanced robotics, and domestic semiconductor manufacturing could be powerful engines for future growth. Strategic investments in infrastructure can boost productivity across the entire economy, and programs for workforce training can ensure that American workers have the skills for the jobs of tomorrow. The goal isn't necessarily to eliminate the debt entirely virtually. No large economy does. The goal is to stabilize the debt as a percentage of our economic output, to get it onto a sustainable path. Finally, there's a psychological factor at play. Markets run on confidence. As long as investors around the world believe that the United States will honor its financial obligations, borrowing will remain relatively affordable. That confidence is built on transparency, a commitment to fiscal discipline, and a credible long-term plan. Constant political brinkmanship and fear-driven narratives can create volatility, while responsible, sober leadership can restore trust. The national debt crisis represents a crossroads for America, not a guaranteed collapse. The nation's fundamental strengths are still formidable. We have the world's largest consumer market, the deepest capital markets, and we remain the global leader in innovation. But maintaining that position requires fiscal sustainability. It requires a shift from short-term political maneuvering to a long-term, strategic vision. The national debt is not just an abstract number on a government website. It represents a series of promises made to our citizens for social programs, promises made to investors who lend us money, and promises made to future generations who will inherit the consequences of the choices we make today. The question isn't whether America has debt. The question is whether we control the debt or whether we allow it to control our future. The United States has reinvented itself and overcome immense challenges many times before. The next chapter of the American story depends on the choices we make right now. Thanks for watching. And if you found this video informative, please consider subscribing for more deep dives into the issues that shape our world.